we only have an hour. It's about 80 degrees outside, so I'm going to want to get going. And so do you. So let's just start right away here. I'm going to try to figure out what I'm doing technology wise. All right. Not financial advice, but if you've been reading the Substack, the link in the chat, you know, what ends up happening is everybody says, okay, well, long-term earnings, yada, yada. We're not going to resolve that here. I'm not going to ridicule more people more than they have earned, right? This has never been the case. Never, right? Never been the case. The money sits in the fixed income market and foreign exchange markets, which dwarf equities. Dwarf. I just cannot reiterate this enough. If you don't understand interest rate markets first, it is almost impossible to understand any valuation of any risky asset, period. I want to tell you, real estate, credit card debt. Nevertheless, happy talk on CNBC, 24 hours around the clock. 23 and a half hours are about the numerator, not about the numerator. Not when the denominator is controlled by the Federal Reserve, the Bank of England, the ECB, the PBOC, the Bank of Japan, the Bank of Korea, the Bank of government of Singapore. Stop this. They don't care about your 10 shares of Tesla. I promise you. It's nowhere on their radar screen in terms of priority. Nor should it be. Their number one job is to pay pensioners. The end. And that's all your pension funds as well. Okay. This chart here is like a 1-year chart on a weekly. Okay. It is also of questionable use. You need to use this one here. And the reason you need to, because you need to see what these wicks look like. See these little thin lines. You need to see what they look like. Because what it told you, let's just take this one here. This is the week of February 13th. Sorry, this one, March 6th. So while the ending here, the close, as you can see on your screen, 4474. Look how much lower we traveled down. 4137.9. That's what professionals are looking at. That's what the professionals are looking at. They're trying to test where buyers appear. And so this is, in the weeds, deep in the weeds, maybe not that deep in the weeds, is, stuff that you can intuitively understand. You can intuitively understand the idea of auction theory. In other words, let's just say, for example, you're auctioning off this mug, Winnie the Pooh. The price you don't know. How do you find out? I lowered it to 475. Still no buyers. 450. Still no buyers. $4. Still no buyers. 275. Bang. Buyers. And you can see, and so in other words, during this week here on this chart that I'm playing with, displaying, you can see it took all the way down to 4106 during this particular week until buyers started buying. While the happy talk is on the numerator, right? This is on to say stuff like stocks. I get all that. But when the denominator is moving around to this degree, what you had is no buying of stocks. This is both the good and the bad, because you can see what has ended up happening is everyone sees this chart. I mean, there's no subscription at all. But over here, what they're not showing you is a bunch of volume here on this side. How much volume at these different price levels? In other words, we got down to $3. Okay, was that one buyer? Was that 50 buyers? So what ended up happening is down over here at these bottom parts, these tails, lots of buyers. Why? It had to have pushed up and closed all the way at 4474. That's within 5 trading days. Right, so if you take high to low there, you can see it there on the math. 340 points. That's a 10% swing, 9% swing inside that week. That's how unstable you are. I've described equities. I've described the stock market like you're the flea on the tail of a dog. That's how dwarfed you are when you're involved in equities. And yet what ends up happening is Monday morning quarterbacking after the fact. It just so happened to be that the denominator has been so stable that it's allowed happy talk. And, I didn't make up happy talk, right? In other words, I did not make up the phrase of happy talk at all, right? Let's just see. Let's see here. So I got a new toy, and the new toy is that I got a new toy, and the toy is that rats. The new toy is that the broadcasting here is obviously different. But if you look up here, and I'm going to be referring back to here, I've already left you with the information. The newsletter already has the information. How much everyone has paid attention to it, I can't really say, right? But it's there. People who have watched carefully here on this Substack have seen not only the breadcrumbs, they've seen the loaves of bread. We're speaking especially quickly. Actually, this is actually the way I feel more comfortable in speaking. But anyway, let's just go up here. You could be an expert in the losses, the logic, the now. Bonds were down. This. I'm not the only person to point out the problem. Happy talk everywhere.
In either case, you have to go back to 1980 to find a year where stocks were down double digits and bonds were down worse. There has been no place to hide other than cash. Even a 5-year treasury, you got slaughtered on duration. And in that kind of environment, you have to learn technicals.
Exactly. So now you can understand why I spend this time here in terms of showing you these pictures. Meaning I'm showing you these pictures because of the fact that where we are going, or in terms of where we are going in terms of my message, fact that you have to know what this auction for my coffee cup and where it is. Because it tells you about probabilities of what can occur for us, right? Because this is not like some kind of self-congratulatory thing. I did not say we were certainly going down. I said it was high probability we're going down. Why? Because I was looking at these little wicks. And now, not coincidentally, we're sitting here, if you keep going backwards, another location where there is conflict regarding what the fair value of my Winnie the Pooh mug is. And that's what ultimately technical, and it's, of course, I'm crazily watering it down. The issue is now, then what is possible? And you'll see the next conflict zone here. Right. So this is a website, so I can't draw a circle with some pretty graphics machine. But you can see where everyone's looking. It's clear. If you just simply follow the explanation that I just provided, right? Quite clear, which is we've got, and this is what's been crazy, is you can see this wide amount of conflict. But then ultimately, as we were talking 2 weeks ago, this zone in here, right in here, this 4,100, mid 4,100s, I've used 4,170 kind of as this conflict zone. And I'm only pointing out what was just said on the CNBC clip. You have to understand the technicals. And by the technicals, what they're talking about is where the supply and demand is, meaning where am I buying or selling this mug? And it's because ultimately the price, the market price, is what somebody is willing to pay. And now that tells you the next conflict zone isn't here. You can, and you'll, like I said, I'm not a person, a day trader, right? Day traders are sitting here and watching this tick for tick, meaning that if they swing around by 10 points here, they're in and out multiple times a day. And if they're wrong, they're out immediately. And if you don't think, anyway, I'll leave a link. There's this person. Let's just see where, let me see if I can get back to here. There is something called, you can look him up. Right there, if you copy and paste that person's and put them into YouTube, you'll see it. I mean, there's no way that these people are faking it. No possibility, right? So I'm giving you the watered down version of what they are doing. Here's your zone. Back to the main point. I put in the Substack, bonds for dough, nobody cares about stocks, because ultimately this. So let's just pull up the 10-year. This is the yield to maturity of the 10-year U.S. government bond for newbies, right? This is the most important number in financial markets. And as I've said on the Substack, I can't name what second place is. There is no runner-up. Maybe the U.S. 5-year, maybe the U.S. 30-year. Not the 30-year. It's the 10-year. And the reason it's the reference point of the maturities where the borrowing occurs. And you can see what has happened. 2.98 now, a week ago. These are not normal. This is not a functional move. If this thing moves 2 to 3 basis points in a day, then that's normal. The idea that it's swinging around 10 basis means that means 0.10. And if you look at a month, you can see how far we've traveled. This is the 10-year note. Let's just say at the end, and you can see, for example, here as a year ago here. And this stuff may not look like a big deal. You've gone basically from the beginning of the year from 1.82 to not doubled, right? That would be taking too big a mathematics shortcut. And you can see its effect. This is not, let's just use IEF. In that zone, what has happened to your U.S. government 10-year, the safest borrower in the world, right? The US government. In that zone, and you can see it. We started the year where this particular security is where? Here. Somewhere in this area here. 112, 113. It's now down to 101. The 10-year note is down by what? Well over 10%. There it is right there, 115. So you've lost 14 divided by 11 by 115. It's the most important security by, like I said, I can't name the second place. While it's this unstable, and you've seen some other moves, right? Where this gone back up. Maybe it's a relief. Nope. This is why Jay Powell gets so much heat. Because who's the party in control? The Fed. Now you can understand my disgust when I'm watching the cost of money. In addition, now you can. Most misleading video I've seen in a very long time. Fed says it'll soon raise rates. This has some home buyers rushing to buy, freaked out that higher rates will price them out of the market. Fear creates bad decisions. The Fed doesn't control mortgage rates. You can understand how frustrating this is not Jay's pity party, like I've said, but you can see how bad it is. This type of misinformation is misleading everyday people in the public who don't understand the Federal Reserve, don't understand interest rates, they don't. And in that, you can see what a disservice a 60-second clip is. And if you take a look at it, let me see if I can go back there. The problem here is that, switching windows isn't that fun. Switching windows is not that fun because what ends up happening is you have to, this is not great. You have to stop screen and then you've got to share another screen and then stuff like that. So my point here is that there's so much noise that it's easy to be pulled off the track. It's very, very easy to pull off the track. You get my sympathy for it. That said, that doesn't mean that I'm not showing it to you. I am, right? I mean, I have every reason to, because I feel terrible when people are misled by the wrong narrative. And now all of a sudden, I didn't know we were going down to 80. Right. And if you were the person who had firmly held, unknowingly clinging on to something wrong, it's hard to throw the stone at who is responsible here. And we go back here. This is the website where I'm showing we're a retirement fund. And like I said, it gets no better as regarding the background. It gets no better. It really doesn't. It gets no better in terms of this particular group, BlackRock, largest asset manager in the world. When they're running a balanced portfolio, in which they are here, your $100 is now 87.4. Your $100 is 87.4. Okay. The issue here is that when it feeds back, and now I've kind of figured out what to do. Let's just see. Promise we'll get there. Let's just stop sharing. There we go. So basically what is, you're now at 87. No one says we can't travel down. And that's why I have tried to show you that. Yeah, let's just do it that way. Right. And I know it's going to look funny for a moment. So now this is why I've shown you kind of, yeah, it can't get any worse. The persons that are looking at this graph, assessing the value of my Winnie the Pooh mug, would disagree. They're looking down here. All eyes down here. Right? Oh, well, that's not, in the context of this graph, this isn't very much. And then that's 200 points. 200 out of 4,100. It's another 5% down. Minimum. That's not including the lowest wick of this tail. Now you can see down here, 3,700. That's 10% lower from this spot. This is my point here, is that, I realize that people don't fully understand what I'm showing them. I understand that. And unfortunately, that's the bad thing about YouTube, right? Which is that YouTube is built so that you're to understand a snippet in 10 minutes. And then, oh, I get it. How's it possible that you have gotten the set unless you subscribe and got told on many, 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 many occasions? Different walks of life, different situations, things actually that people know, because you can see it here. Now, if you've seen the newsletter, you've seen this. I send it to you frequently. It's hard to come to settle and say, oh, we're already down here, so therefore we're already down over here, or something like. No. Monday you start here. Monday you start here. And the reason for showing you this is to show you an idea on how far this distribution, this bell curve looks. Right? We could be on either side of the coin. You need to understand, okay, how flat or how narrow is this curve here? From that spot, you then work to yourself and go, okay, if we go down there, that means we're not going to be at minus 12.6. You're going to be minus 15, minus 16 in that instance. And your $100 on January 1st is now 85. I'm not here to tell you that 85 is good or bad. I'm telling you that I'm not making it up. And I'm telling you also with multiple pieces of evidence here from the best in the world that the information here on Jay's Corner just could not have been wrong because I've had a front row seat, but in addition to that, there's only one way to get to this spot, to the super advanced of you, and there are super advanced in this audience, right? The number of viewers, I understand who's watching, right? There are persons way more educated than me, way more educated than me on this, right? I tell them, hey, this is a linear algebra formula that is an optimization based off some restraints. Bang, they immediately understood it before I finished the sentence, I promise. That is the result of it. And they're using the same construct. They're using the only way to have gotten to this number. And if you think that's oops, and we'll have some other thing. This is Vanguard's same target date, 13.44. And now actually you can see what has happened. In prior editions of this newsletter, I've pointed out that between these two screens has been 0.3. It has widened here to 0.8, and that is noteworthy. That is noteworthy. That difference may look small to you. To them, it's enormous. To them, this is enormous. Because it tells me that underneath that what actually is underneath the hood is actually now different. Someone has adjusted here, or someone's underlying pieces of the pie is different, because you wouldn't have been able to come up with now this widening difference of 0.3% to 0.8. If that is looks small to you, it's enormous to them. Because you can see other versions where I've tried to point out that how thin this is. Why? The math guys have it right. Right? The ones who have created these models have made it right. We don't have a crystal ball. What I'm trying to show you, however, is about the width of this. This is a mentality here. And this is why YouTube doesn't work, candidly. A 10-minute video, well, we've burned through 30. I've had to shut off a ton of different details. I'll leave you at the last point. Dwarfing even the bond market sits the foreign exchange market. And the reason that you don't, this here, right? So basically what happens is, the bond traders laugh at the equity traders and the stock traders, because the equity traders are trading such a small dollar amount, monetary amount, that, it's like the minor leagues. That's how the institutional world works, right? Your traders of Salesforce, they're nowhere on the radar, right? Their conversations are to a mutual fund owner or mutual fund manager. The bond trader is talking to, the central banker, right? And above that is foreign exchange, who's then laughing at the bond trader. This is a problem. We don't know exactly what is going on here. We don't know exactly, and it's not in the news. This is 103 to 130. Right? So if you had 100 yen and brought it to 103 yen and brought it to the United States in 2020, at the end of 2020, it was basically worth, as you can see, 97 cents. Look at it now. This is taking, even from here, 115, end of the year. So your vacation to Osaka is now far cheaper, right? Instead of like $500 for dinner, it is now $450 for dinner. Congratulations, right? This is the third largest economy in the world, whose currency has dropped by 20% in 3 months. This is worrisome because and let's just talk about bonds and the flow through bonds. When I tell you that these things are related, here's how they're in a relationship, and how little and how unhappy I am about Happy Talk, about the denominator. To the Bank of Japan, what they can do is they can sell their US Treasury holdings and now get back yen, which is all they care about. Their liabilities are in yen. So now with the US bonds, guess what? And it pay, and they got 103 yen, 115 yen. They now get to redeem it for 130 yen. So remember I told you that IEF lost 10%? Yeah, well, they got the 10% back in yen terms, like that, of which they can use to pay their pensioners. Meaning that part of the reason that the bond market has been this low, this stable for this long, is you've had foreign buying. And top of the list, very near the top of the list, is the Bank of Japan. And the other East Asian countries, by the way, right? With huge foreign reserves resulting from net exports. They aren't necessarily a buyer here. Why? It's too expensive in yen. They would have to take their yen, convert to dollars, and then buy US bonds. That may have been fine at 100 yen to the dollar. It's not fine at 130 to the dollar. Well, guess what? That whole thing has interest rates underpinning stocks. Now you kind of understand why I say stocks for show, bonds for dough. And actually, I needed to have and foreign exchange is laughing at both. That's it for market talk. We got 28 minutes. I promise to keep you down to an hour. Let's go over here. Okay, so Commonwealth Fund here is talking about Medicare Advantage. You can see it's just the other day, May 3rd. Medicare Advantage, crazy people, write books, new edition. It's so weird. Like I see this, how thick this is. I'm like, who did this? Who did this? Anyway, Medicare Advantage, half the market, certainly going to be half the market, going to exceed that. I'm very comfortable with that conclusion. That's what CEOs have told you. That's what I would tell you as well. That makes total sense. Why? You must be part of Part A and Part B. True, that's true. Medicare Advantage can cost $0 in many locations in the country. Many. Not every, many. That all said, you have to understand network. And there are a ton of nuances in Medicare Advantage. The book, 100 videos? Every time I'm asked about Medicare Advantage, which is in public view, scripted and unscripted. I guess some of that is public presentations, but in interviews, which total basically around 200 at this point, more than 200, I'm confident, over 200 times in public, I've basically said, look, if you want to understand Medicare Advantage, you must understand the network. Must. Right? You want to drive down cost, which is the very point of Medicare Advantage. You want to drive down your out-of-pocket cost. You have to understand network first. Anyway, you got down over here, and what you're going to have on YouTube and other locations is Medicare's bad, Medicare's a ripoff. I get all that. Okay. Well, I'm going to address some of that here. So first of all, Commonwealth Fund, much like BlackRock when it comes to financial markets, it gets no better than Commonwealth Fund. There's one other called Kaiser Family Foundation. These are the two. I pick on them specifically because I point out because there's no faking the qualifications of the persons responsible. None. Right? In fact, the person head of the Commonwealth Fund, you can see on Substack, I have complimented her on multiple occasions. This article is not wrong. I'm not disputing the facts here. I am disputing in advance what I promise you will see to be the distortions to come by others. Certainly the case. Medicare Advantage grown rapidly. Yep. In 2012, in this area here, I wrote about Medicare Advantage. Medicare Advantage was far weaker then. It was both more expensive and more restrictive. Both, right? I can be more restrictive. I need lower cost, dramatically lower cost. You can't be both more restrictive and higher cost. That's what Medicare Advantage was before. That has ceased. Competitive pressures have squeezed those out. So as a result, increased market share. Very simple. Simple stuff. You don't need to know anything about Medicare, right, in order to understand that explanation. One setup was more expensive and more restrictive, except for the competitors squeezed it out and forced them to, in order to survive. And guess what? It improved. Increased market share, of course. 43% in 2020. By 25, half of Medicare. I probably think that, well, in many locations in the country, it's more than 50% today. Access to providers, differences. Like I said, you need to understand medical network. Managed care. Okay. So this is true, prior authorization, right? In other words, when I tell you that Medicare Advantage is different than Medigap, Medicare Advantage, the carrier is the conductor. They call the shots on everything. That doesn't mean bad, necessarily bad. I'm just saying there's this layer of extra decision-making power. Under Medigap, there is none. It's just the federal government. So you can know that prior to Medicare, for example, you may have been, somebody said, okay, you need to have this surgery, you need to have this procedure. You then had to get prior approval, prior authorization. That exists in Medicare Advantage over here. No question. Under Medigap, if it's approved by the federal Medicare standard, then you're approved. The Medigap carrier is not intervening. The Medigap carrier cannot intervene, right? If CMS says yes, Medigap must say yes. The seller, the Medigap carrier over here, they have no say. You are paying a higher price for the fact that they don't get to intervene. Covered benefits. Yes, all true. No question, true. Traditional. Where is it? I need to go to the punchline, and I'm trying to get there here. Here we go. Must pay the Part B premium. Here. What's going to end up happening here is the following. I promise you that at some point, and you'll see it already, I'm not going to dignify them. You're going to say, this is evidence of the fact that it costs more for Medicare Advantage. Right? That it costs more for Medicare Advantage than under original Medicare. You're going to see studies and people that say they're going to cherry pick out and saying, this is my evidence. See, Medicare Advantage is a ripoff. It's too costly. Original Medicare has no out-of-pocket maximum. Original Medicare has no out-of-pocket maximum. Medicare Advantage must have an out-of-pocket maximum. Must. So, of course, Medicare Advantage costs more. Medicare Advantage is creating this extra layer of protection against bankruptcy that original Medicare does not. That is not zero probability, so its cost is not zero. Nevertheless, what we are going to have is we're going to have some conflation of these facts. Sorry about this. I'm wondering if I'm actually even, broadcasting correctly. And you can see it here. In other words, if you have a $3 million of under original Medicare with the red, white, and blue card of loan, you owe, and those were just doctor's visits, you would owe 20% after meeting the Part B deductible. So 20% times 3 million is 600,000. If you're under Medicare Advantage, the maximum downside to you is 11,000 maximum. And your individual plan is all the plans and competitions over 100 in Tampa, 100, more than 100, are fighting over every last detail of which these are included. This is an extra layer of protection for people. So as a result, of course, they have to charge. And this is what I'm saying is that, what will end up happening is I promise you that somebody's going to cherry pick out, oh, it costs more. See, the Commonwealth Fund says it costs more. Right? There it is. And the people who are going to take this, pull it out of context and say this makes Medicare Advantage a ripoff. To the policy owner, they're getting this protection here that they don't get under original Medicare by itself. Now, let me just swerve to one other thing. You'll see the rest of this article, which is, this is a different topic down here. Okay. It is difficult because there are so many issues. There are so many stakeholders. There are so many different interests. The stakeholders are smart, right? It's not only insurance companies, it's doctors, hospitals, pharmaceuticals. The parties involved are smart. The thing under Medicare Advantage, and you can see it here in this panel, which is, let's just say, for example, you're a B student, and then you come home and you say, Mom, Dad, I got an A-. They're ecstatic, right? You've had a history of B, 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 and then you get A-. Well, you get an allowance. You get an extra bonus to your allowance. They take you out for dinner. Same thing here in Medicare Advantage. If you get a bench, so now you can see it, benchmark, incentives. And there it is. Medicare Advantage carriers have the inherent motivation to try to beat benchmarks. Right? They want satisfaction. And for that, you get conflicts of interest. Maybe. And you can see here that if they beat benchmarks, they can even get money back. If they get 5-star ratings, they can get extra allowance. And then they get extra money if they're helping the very ill. Meaning that, let's just say you're Mr. Sick a lot, right? You've got 5 incurable diseases. You're 3'5", you weigh 900 pounds. You drink like, a fifth of Jack Daniels before 8 a.m. You're risky. In that instance, what happens? The Medicare Advantage carrier gets extra money. Why? Because they're more likely to hit this out-of-pocket maximum. No? And so as a result, what you can see what does end up happening is that you have this risk adjustment. This is the controversy as stated here. And again, I'm not picking at, groups that are reporting in an overly biased fashion. Those persons, I won't dignify them. Or lawsuits. And they're quoting other locations. Here's the Bloomberg report. So now you can see the link back here to this first article, which is they're getting extra money for this risk adjustment, which means extra money to the Medicare Advantage person. And these alleged matters to say by the whistleblowers are that they're billing for illnesses that do not exist. I don't have an opinion here other than, if true, this is a systematic problem. If the sellers are found doing it, and some have been, I promise you here that you will see it here, that there's going to be, if you did do this and look in here, etc., etc., if you look under the way that I just Googled, you will find settlements, you will find sanctions, right? There's enough smoke here where there are at least evidence of some fire, whether it's systematic or any carrier. You'll note here, I'm not naming a carrier. I'm just saying that if true, is this taxpayer money? The answer is yes, it must be, right? The monies are coming from the federal budget. You don't get lots of sympathy from Jay, the taxpayer, if systematically doing this. That is different. And this is the difficult thing about Medicare, which is there are so many issues. The entanglements are everywhere. I mean, because the stakeholders are this big, this important, this well qualified, right? If this were like three village idiots, we just, flick them away. That's no problem. We just somebody just steps on them. That's fine. You can't do that to the AMA. You can't do that to the American Hospital Association. Can't. It's just not possible, right? They have reason and they're going to be rational. I didn't say 100% correct, but from their point of view, they're going to be rational. But you can see what has happened here, right? Which is that on one hand, the buyer, the policy owner, right? The policy owner is definitely better off. They live check to begin. And they get this cap on financial liability for zero premium. Crazy people write books saying don't go with original Medicare, the red, white, and blue card by itself. Why? Because of that right there. That doesn't exempt you from needing to buy the book. But anyway, you can understand my point, which is this is the forest here. You're living check to check. You have health issues. You have 3 medications, etc., etc. Yes. Do you have to deal with all these things up here? Yeah. Those are trees in the forest. Here's the forest right here. And the fact of the matter is, you can even that these things could exist, maybe, which is unproven. The tough spot here is that for the policy owner, this is still the forest. Nevertheless, I promise you in the coming days, sure as I'm sitting here, it's not the unpredictability of this, right? Sure as I'm sitting here with 90% probability, and I'm low, you are going to see somebody cherry picking this very article to say this is evidence that Medicare Advantage is a ripoff. Or another excuse of why Medicare Advantage is wrong. Bad for the country. Those are different topics here. You don't see pictures of Socrates or, the GOP slogan here. I don't care. What I'm talking about is describing to the person, the policy owner, who does. Let's not be unlimited financial exposure to the downside. You can limit your financial exposure in two ways: Medigap, Medicare Advantage. And let's not be distracted from one of the ones on Medicare Advantage because of this stuff over here. I can't fix this anyway. I don't have the evidence. I'm not going to be sympathetic if the evidence is abundant. No one's sending me files. No, it's going to be tough to prove. I'm just leave it with you that way. All right, that's all I got here. Excellent. 11:51, 50 minutes. I'm trying to make it short and tight. And the reality is the fact is that the reason I wanted these live is because I don't have time to edit fully, is the candid reality. Be sure over here, in here are videos that I did. This is very scary, by the way. For those of not on current events, this means what? I got my stimulus check, and now either my savings rate is because what? Oh, maybe I've paid down my credit card debt. Nope. Didn't want to really see that, to be candid with you. All right. Thanks, everyone. Questions, emails, be sure to share the channel, please. Not enough people as a result of, a bunch of different reasons, largely of my own doing. Not largely of my own doing. I get all that. All right. Thanks, everybody.